Hello, and welcome to the Wall Street Millennial Podcast. We're doing this emergency podcast today to address some of the recent events that have been happening in the markets, starting on Friday and then continuing again today on Monday. So, as you probably already know, Silicon Valley Bank, uh, the 16th largest bank in the U.S., failed over the weekend and was taken over by the FDIC. And so today, what we want to do in this podcast is go over what happened and what it means for the rest of the stock market, and specifically some of the other banks that are under pressure. So here's a timeline of what happened with Silicon Valley Bank's collapse. So going into this year, Silicon Valley had a large number of held-to-maturity securities on its portfolio, which basically means that they don't have to report the mark-to-market losses and gains on these securities because they're supposedly planning on holding them until um, the bonds mature. But anyway, because of the Fed's rate hiking cycle, these held-to-maturity securities carried a $15 billion unrealized loss at the beginning of this year. Um, this was mainly driven by the increase in interest rates, but exacerbated also in terms of the bank by increasing customer withdrawals um, leading up to the collapse. So Silicon Valley Bank is a little bit unique as far as other regional banks in that most of its customers are tech startups and venture capital firms and other people involved in the Silicon Valley startup community. So these customers started withdrawing a lot of their deposits in recent weeks and months because, in large part, also because of increasing interest rates, and that eventually caused a lack of liquidity in addition to Silicon Valley Bank's insolvency. So on Wednesday, March 8th, they announced a proposed stock sale in order to raise capital and raise liquidity in order to meet these deposits, uh, these withdrawal requests. That spooked the market and eventually led to a run on the bank because when a bank announces a surprise stock sale, that's never a good sign. So on Friday, CNBC reported that the bank failed to find a buyer, and obviously they're in big trouble at that point. And also on that day, the FDIC took control over Silicon Valley Bank because they had basically become insolvent. Later that weekend, Signature Bank, another regional bank, also a very large regional bank, also collapsed. And that same day, many people think because it is no longer just one bank, the contagion was starting to spread. The U.S. Treasury and Fed unveiled their measures to try to nip it at the bud and cover all the SVB depositors. The Fed also unveiled their Bank Term Funding Program in order to prevent the same thing from happening at other banks, which basically the terms of this program were to allow banks to post their like treasury securities as collateral um, for up to 1 year termed loans from the Federal Reserve in order to increase their liquidity and be able to meet deposits. This was an attempt to try to stop the effects of bank runs going forward for other banks and to prevent the contagion from spreading. So that's a brief timeline of what happened over the past couple of days. Obviously, a lot has happened and the markets are roiled. And but what's really important is what's going to happen going forward and what it means for especially some of the other banks that we've seen down 20, 30, even over 50 or 60% just today.
Yeah, I think it's really important to just take a step back and try to figure out what's going on because everything, going back to the timeline, everything happened so quickly. So March 8th, that's the first announcement we got from SVB saying that something is up. 2 days later, the bank fails, right? And then 2 days after that, another bank fails, Signature Bank. So, and then the next day, they announced the U.S. Treasury announces that they will cover all SVB deposits, not just up to the $250,000 threshold, but all of the deposits. And the Fed also unveils this bank term funding program. So everything happened within the span of just a few days. And whenever, I guess this is a collapse of a $200 billion bank is a big deal. So markets were obviously very concerned about that. There's been like a lot of comparisons drawn to the 2008 financial crisis. Are we at the beginning of another, disaster like that? That's what people are scared of. And we can really see the panic set into the market just by looking at the share prices. So here we have three lines on the chart. So this dark blue one is Silicon Valley Bank stock. You see that after March 8, it started tanking. Here it was halted and delisted because now it is bankrupt. And then this yellow line here is the iShares Regional Bank ETF. And this turquoise line at the top, this is the XLF Financials ETF, which is like the large cap banks. So think like Citi or JP Morgan, Bank of America, and whatnot. They are in the turquoise one. And the smaller regional banks is the yellow one. So as we can see, the regional banks have decreased by 32% in the past month, while the large cap banks have only declined by 14% in the last month. And I think there's probably a couple of reasons. There's a couple of reasons for that, that the large cap banks have outperformed the regional banks. One is that the large cap banks, most of them are deemed by the Federal Reserve to be systemically important financial institutions. That means that there's a greater level of scrutiny every year. The Fed does a stress test with them to make sure that their balance sheets can handle a liquidity crunch, and they would still be able to honor all of withdrawal requests from their depositors. The smaller banks, the regional banks that don't have as great of scrutiny because they are not systemically important financial institutions. So Silicon Valley Bank was not a systemically important financial institution. They did not undergo these stress tests, and that is one of the reasons I think that made them a bit more vulnerable. And nobody really, the regulators didn't really know something was going on until it was too late. But, we see the panic setting into the market with the other banks, especially regional banks, decreasing a lot in value. But I think it's important to look at what were the specific issues at SVB that caused it to collapse, and are those same issues likely to affect other banks? So here I have some numbers from SVB's balance sheet as of the end of 2022. So December 31st, 2022, that's the most recent financial statements they had published. And they had $211 billion of total assets and $195 billion of total liabilities. So which is the liabilities are the deposits as well as some other borrowings. So if you take the assets minus the liabilities, that gets you the book value. So on their balance sheet, the reported book value was $16 billion, which is 8% of their total liabilities. So they had 8% of their, they had kind of an 8% cushion. So they were solvent according to their financial statements. Their assets were greater than their liabilities. However, as Ryan mentioned earlier, they had $15 billion of unrealized losses on their held-to-maturity securities. And these numbers were not reflected in their reported book value. If you subtract those, that $15 billion loss, book value goes from $16 billion down to $1 billion. $1 billion is only 0.6% of their liabilities. So here you can see the bank, it was solvent, but barely going into 2022 or going into 2023. So they were sitting on a knife's edge. And then as people started to get worried about that, that's when, we saw it unravel very quickly. So you really had a confluence of two issues coming together. First of all, they were in a very vulnerable position because of these unrealized losses. And second of all, their deposit base, where it was mostly tech startups and companies. And there's two problems with that. First of all, since it's, some tech company has a bank account with SVB, chances are they have a few $1 million in the account, or maybe tens of millions of dollars in the account. I think, for example, Roblox had something like $150 million, right? So if you have $150 million in your SVB account, and then the federal deposit insurance only covers $250,000, that's like that $250,000 is nothing, right? So if you're a company, you're the CFO of some company, and you have $100 million in a bank, and you think that bank is potentially going to be insolvent, well, you want to withdraw money as fast as possible. And that's exactly what we saw um, at SVB. I think the FDIC said 95% of SVB's deposits were not insured, and that's because the vast majority of it was this very large accounts with tens or hundreds of millions of dollars in it. So that got the deposit base of the tech companies got very scared, so they all started pulling their money out at the same time in a classic bank run scenario, and that forced SVB to start selling off their assets, selling off their bond portfolio, recognizing these massive losses, and then becoming insolvent. That's why we have the collapse. So now that has happened, I think the next thing to look at is, so these here is a bunch of regional banks. So these are all of the components of the iShares regional bank ETF. And all of them have seen massive declines. So the minimum decline is 10%, and the maximum decline is First Republic Bank here, which has declined 75% since the beginning of March. So I have done some looking through these banks at whether there's any deep value opportunities here. And the main criteria is we need to find a bank that the share price has decreased a lot, making the valuation attractive. But at the same time, the bank is in a solid financial position such that they're not going to end up collapsing like SVB did. And through my research, I've found Western Alliance Bancorp, WAL, as being the best opportunity, in my opinion. So for full disclosure, I bought a position in Western Alliance Bancorp. And this video is not financial advice, but we thought we would just go through and show you how we're thinking about things. So Western Alliance Bancorp is a regional bank. It's headquartered in Arizona, and its branches are mostly in Arizona, Nevada, and California. So almost immediately after the SVB collapse began, the stock started tanking, and it's now lost 65% of its value kind of since this whole thing, this whole episode started. Now, here I have some selected numbers from Western Alliance's balance sheet, which is, this is also as of December 31st, 2022. So the bank has total assets of $67 billion, about almost $68 billion. They have $700 million of goodwill, and they have $172 million of unrealized losses on their held-to-market securities. So if we subtract these two, we get our real tangible book value of $67 billion. This is against total liabilities of $62 billion. So their real book value, and what I call real book value is book value minus any unrealized losses, is $4.5 billion, which is 7% of their total liabilities. Now, remember, Silicon Valley Bank, at this same time period, their real tangible book value was only 0.6% of their liabilities, Western Alliance is 7%. So Western Alliance is in a far better position financially than Silicon Valley was. And on March 10th, so kind of this is on this past Friday when the Silicon Valley was starting to blow up. They released this press release on their website, trying to reassure the market about their financial position. And you can read this for yourself. It's on their website under press releases. But I have also condensed the numbers they have here into this Excel here. So as of March 10th, 2022, their total deposits were $61.5 billion. Of those deposits, $8 billion were from tech companies and life science companies. So these are kind of the risky depositors. Those are, these are similar depositors to what Silicon Valley had, causing Silicon Valley to collapse. But against these deposits, this is Western Alliance's liquidity position. So they have $2.5 billion of cash, a $13 billion credit line with the Federal Home Loan Bank of San Francisco, $4.4 billion of credit lines from other financial institutions, a $5 billion credit line with the Federal Reserve Bank of San Francisco, and then $5.3 billion of unpledged available for sale marketable securities. And because they're available for sale, these are already marked to market. And then they also have $1.1 billion of held to market securities. So they actually have like $1.3 billion of held to market securities, but I subtracted $200 million for their mark to market losses, which they disclosed in their prior financial reports were $172 million. So I'm already subtracting the unrealized losses here. So this gives them total liquidity between the cash they have on hand, the credit lines they have available, plus the marketable securities that they can sell at fair value, valued at fair value, gets you $31.6 billion of total liquidity. This is more than half of their total deposits and far in excess of their tech and life science related deposits. So you would need a serious bank run for Western Alliance to collapse. And then on Monday, March 13th, they released another press release talking about their financial situation. And they said some encouraging thing here. So they say, as of this morning, cash reserves exceeded $25 billion. So their cash reserves as of last Friday was $2.5 billion. Now it's $25 billion. So this is because they drew down on all of those credit lines, right? So they disclosed previously they had all these credit lines with the San Francisco Federal Reserve and a few other institutions. And so they were able to draw on those credit lines. And now they have a very large cash position, which is the cash position now is almost half of their deposits. They say deposit outflows have been moderate. Okay, well, moderate is a qualitative term. We don't really know what moderate means. Is it 1% of deposits have been withdrawn? Is it 5%, 10%, 15%? You could say anything is moderate because it's just a matter of opinion. But what I think is important is insured deposits exceed 50% of total deposits. And this is really important because remember with SVB, only 5% of their deposits were insured. The reason being because as we talked about earlier, their depositors were tech companies and whatnot that had millions or tens of millions of dollars in deposits. Well, Western Alliance is more of a normal bank where a lot of their deposits are from individuals. So an individual most likely isn't going to have more than $250,000 in their bank account. So the whole thing will be insured. They have some, companies or maybe high net worth individuals, but overall 50% of their deposits are insured. And if your deposits are insured, there's no reason for you to withdraw, because even if the bank fails, you're protected. So this is, I think, a very encouraging sign. In my personal opinion, I think, if these numbers that they're telling us are true, I don't see any realistic way that Western Alliance could collapse in a similar way to SVB, because the nature of their customers, the position of their balance sheet is just night and day. And what I think, in a time of panic after the SVB collapse, the reaction from a lot of investors was sell first and ask questions later. And I think that created a really attractive opportunity with Western Alliance. To buy up the shares at a 2/3 discount. And in my opinion, it looks like they're in a strong position to weather the storm. And I'm sure Western Alliance is not the only opportunity out there. You see here, there's like a sea of red. All of these regional banks are tanking now. I have not had the time to go through and analyze every single one. I'm sure some of them are more vulnerable than others. But, as an investor, I think if you just look through each one of these banks, and you can try to look at the balance sheet, look at what statements they've made, what the nature of their depositors are, and you can probably find some pretty good bargains here.
So it brings up a question that I had, was that what is preventing a deposit? What is the incentive for a depositor to stay at a bank like Western Alliance or First Republic in general? Is there really any cost for them to move to a JP Morgan or Bank of America, which we know are seeing billions and billions of dollars of inflows because of this? Why doesn't everyone just move?
Well, in the case of, say, Western Alliance, 50% of the deposits are 50% of the deposits are insured. So if you have less than $250,000, there's really no reason to move. So that's not really an issue. Now, as far as the other 50%, the people who have who have more than $250,000, I think the reason why you would not move is because as we went on the timeline, so the U.S. Treasury announced that it would cover all of the losses of Silicon Valley Bank's depositors, even the uninsured deposits. Given that that is the case, that they bailed out basically SVB. Well, they didn't bail out the shareholders. They bailed out the depositors. Given that they bailed out the depositors of SVB, one would stand to reason that they would probably bail out the depositors if another bank collapses in the future. So I think the chance from the depositor's perspective, even if you have more than $250,000, the chances of you actually losing anything are extremely low. And there are costs to, if you're a company and whatnot, there are costs to switching your bank account. You have to go through various procedures with setting up a new bank account, with all the know your customer and such. It's just kind of a pain and takes some time to do. And also the large banks, the ones, like the JP Morgan and Bank of America and whatever, they typically offer much lower yields on savings accounts for that very reason, that they are perceived as being more safe. So they can, it's easier for them to attract deposits. So they offer lower savings rates on savings accounts than the smaller regional banks, which provides an incentive for people who care about that savings yield to go with the regional banks. And then finally, regional banks, they often have more expertise in their region, so they know the community better, and that makes it kind of easier for them to give out loans and such within the community, where a large national bank like Bank of America or whatever, they might not have expertise in that region, so they would be less willing to lend to borrowers in that region that don't have as much of an established credit history, while a regional bank with greater local expertise may be better at providing credit to people whose credit profile is more difficult to assess. So it can be advantageous as a local business to have a relationship with a local or regional bank that knows that area better. So there is some benefit to using a regional bank in some cases, and I think the risk is extremely low given the fact that SVB depositors are bailed out, given the fact that the Fed unveiled this the Bank Term Funding Program, which will shore up liquidity, um, and also given that in the case of Western Alliance, their balance sheet appears to be in a very good position. And I think it's one thing that's interesting. So the Bank Term Funding Program, I don't know if we have gone over this already, but the thing that's really important about it is that so they offer loans to banks of up to 1 year in length, and to get a loan under this program, you have to pledge U.S. government bonds, U.S. treasuries as collateral. So you give them your treasury bonds as collateral, and they'll give you cash as a loan in return. But what's really important about this is that these assets will be valued at par. So it's valued at the face value of the bond. So the problem with SVB is they owned all these government bonds that the market value had decreased substantially over the past year as interest rates had risen, but the par value did not change. It's still the same par value. It's just the market value decreased because the interest rates went up. So had this program been in effect prior to SVB's collapse, SVB may not have collapsed because they're going back to this thing, right? So this was their reported book value of $16 billion in blue. This was their unrealized losses. But they could have basically borrowed this $15 billion from the Fed had this program existed at that time. And then they would have had the full $16 billion of cash. And that would be enough to cover their withdrawals. You know, they're going to have to pay back this unrealized loss to the Fed after 1 year. But that gives them a whole year of runway to try to, arrange some capital injection, possibly sell a large equity stake to another bank, or maybe even arrange to sell themselves to another bank at a low price. But they at least would have had a year to figure it out, not 48 hours as they had this time. So I think that the chances of another, I mean, there could be more banks that collapse, but the fact that the Fed's new term lending facility will be, I think, a big help to a lot of banks that have unrealized losses on their balance sheet.
And like that $15 billion unrealized loss, like theoretically, if they hold it to maturity, it will go to zero, right? Like I think Silicon Valley banks, their average time to maturity was like 5 years or something. So this would only give them 1 year. But theoretically, the reason they're held to maturity is because the mark-to-market changes in market value don't really matter if you have the ability to hold them to maturity.
Yeah, exactly. So if they could just go, but then say you want to withdraw money from your bank account and they say, it's going to take 5 years to process that withdrawal. People aren't going to be too happy about that. But that is the crux of the problem, right? It's really an accounting thing where I say, I intend to hold this thing to maturity, at which case I get my par value back. So I'm just going to value it like that. But that presupposes that you have the ability to hold it to maturity. And they thought they did. That's why they labeled them as held to maturity as opposed to available for sale. but as it turned out, they did not have that ability, and the results were disastrous.
Yeah, they just exposed themselves to way too much interest rate risk and tried to capture too much of a spread by borrowing overnight and lending, buying these long dated treasury bonds, and it didn't work out for them.
Yeah, and I think that's kind of a key difference with the 2008 financial crisis, because in the case of the 2008 financial crisis, the issue was not the interest rates. The issue was all the defaults of the mortgages, right? So all these banks were facing massive defaults, and then that made them to go insolvent in some cases. Here we don't have a default problem. The default rates are still quite low. The problem is the interest rates, the massive unrealized losses on the interest rates going up, and I think that's maybe part of the consequences, right, of all the inflation we have now, and the fact that the Federal Reserve had to increase interest rates so rapidly. That does cause a huge amount of unrealized losses, and a lot of banks are vulnerable. So don't get me wrong. I'm not saying that everything is going to be fine now. There are still a lot of banks out there that have massive unrealized losses, and are in a very precarious position because of that. The point I'm making is that not all banks have such massive unrealized losses. So um, I think that you have to differentiate, the good banks from the bad ones, because anybody could have looked at Silicon Valley Bank's financial statements as of December 31st, 2022, and seen that they were in, a really bad position. Their book value was basically zero, which is not good, right? So anybody could have seen that, but people weren't really thinking about that. I guess investors got lazy, didn't really think about these tail risks of what happens if all the depositors want your money and you have to recognize these massive losses. And now, kind of reality came crashing down like a ton of bricks.
And the
And
management, it was a huge oversight by management to put themselves in this position, right? I thought something that was kind of interesting was that the CEO of Silicon Valley Bank, Greg Becker, uh, was also on the board of directors as a director on the Federal Reserve Bank of San Francisco. So that kind of begs the question, like, the management was not doing their job. Risk, I think they didn't have a risk officer on their um, at the bank for the past nine months before this collapse, and then it seems like the regulators could have done more to detect this and um, flag it before the collapse actually happened. Um, but I guess from a stock trader, like investor's point of view, and we'll say it again, this nothing in this is, or nothing on our channel is ever investing advice, and probably especially today and with this topic, since there's so much volatility with stocks getting halted every few minutes today, and things of that nature. But I think from the way I view thinking about buying some of these regional bank stocks, and James, let me know if I'm saying anything that you disagree with, but there's basically kind of two outcomes, right? Either a bank has a bank run and can't meet their deposit, can't honor their deposits, and they fail, right? And the stockholders get wiped out, stock goes to zero, or they survive. And at the end of the day, maybe they have some long-term harm to their reputation, but they eventually recover to how they were before, and their stock basically goes back to what it was before. So there's basically two outcomes. And when you have a situation like that, the percentage decline from before this entire Silicon Valley collapse happened is basically a market implied probability of those two potential outcomes, right? So if you see for example, Western Alliance Bancorp down 70%, then that's basically saying that the market is implying a 70% chance that they're gonna fail, and a 30% chance that they're gonna survive. And full disclosure, I have a relatively small position I've been trading in and out of both Western Alliance and First Republic. But at the lows, I think Western Alliance at one point was below $8 a share.
Yeah, and it was $70 a share before, as
Right.
of Thursday.
So at its low, basically, there was a market implied 90% probability of the bank not making it through this entire thing.
And I think,
it seems extreme.
I think that's absolutely correct, and I think it's a very extreme reaction. I think given everything we went over about the balance sheets, about the statements they put out saying that we have all these lines of we have all these credit facilities, and they were able to successfully draw down those credit facilities. And now they have $25 billion of cash on their balance sheet, and 50% of their deposits are insured. I mean, it seems very difficult to say how you would get to a 90% probability of a failure. I would say it's more like a 10% probability of a failure, to be honest, in my opinion, of course. But I think with the extreme volatility, almost by definition creates opportunities, because as they say, the stock market is a voting machine in the short term and a weighing machine in the long term. And if you can at least have some idea of what is the probability that the bank collapses, what is the bank worth if it doesn't collapse, and you have a pretty wide margin of error when the stock is swinging around so much. And once it's down 90%, if you think it's anything less than 90%, even if you think it's only 80%, well then, it's still, potentially an attractive buy at $8, depending on your risk tolerance. So I think, if you have, a strong stomach, and you do your research, and you are, you have some money that you can afford to lose, I think there are some really interesting opportunities.
Yeah. And that is all in terms of expected return, right? Like thinking about the probabilities and the potential outcomes. But obviously, the potential outcomes are you could lose all your money. So
so keep that in mind. Because even if it is, if I say it's a 10%, say I think it's a 10% chance that Western Alliance collapses versus a 90% chance implied by the market at the lows of its trading. So even if you're right about that, and it is only 10% chance, well, a 10% chance can still happen. So you can still lose all your money. But so that's why you have to be smart about, the position sizing, knowing the fact that, I think you should prepare that any bank in this environment could collapse, right? With all the fears from depositors, it is, possible. There's a non-zero probability that any bank could go to zero. You just have to say, what is that probability and how much risk am I willing to take? Because if the bank doesn't collapse, the upside can be enormous.
One final thing that's kind of going through my mind, James, I want to see what you think about this idea, but it's probably also not a good idea to underestimate the liquidity of the investing market at this time either, right? Like over the past 6 months, the markets especially certain sectors of the market have taken huge losses, and maybe not as much now as like going into 2023, but a lot of people are probably more risk averse just by nature of huge losses that they are sitting on in other parts of their portfolios at this time, which could probably contribute to the violent volatility, especially downward whenever there's fears.
Yeah, imagine that you were an investor and say maybe going into 2022, you were all in on technology stocks, and then you had massive losses. And then going into 2023, you say, okay, I need to lay off of these technology stocks and I'll instead go for banks, which are a safer bet. And then you see the banks are starting to collapse too. Then I think you would be extremely scared. And given the given
Less
the
margin available, both because
yeah.
of their losses and because margin rates have basically quadrupled at a lot of brokerages.
Yeah. So I think, 2022 was a very bad year for the stock market. And I think to your point, that probably caused a lot of, psychologically, that has probably caused a lot of fear in the market. Everyone is sitting on the edge of their seats, seeing, how much lower can we go? And then the last thing you need is the 16th largest bank in the US collapsing, and then that really kind of, um, you know, that really kind of does it for you. And you just get so scared, you want to pull out of everything. And that's kind of, yeah, and then that creates this mentality of sell first, ask questions later, which I think is what we've been seeing with a lot of these regional banks.
But then it can also eventually lead to a huge rally when people, if things do start to get better, and once it becomes clear, people will realize that that dynamic is what's happening and not want to miss out. So you could probably snap
Absolutely.
back just as rapidly. But yeah,
Yeah.
the second and third largest bank failure in history with Silicon Valley and Signature Bank, I believe. Um, it's the people talk about like the Fed raising rates until something breaks. This definitely qualifies as something breaking at this point.
Yeah.
We'll see what they do at their next open market committee meeting, but I would be surprised if they hike rates as much as the 50 basis points that people had been expecting before Friday.
Yeah, that's actually another good thing about these bank collapses is that it might cause the Fed to dial back on the rate hikes, which will be beneficial for a variety of reasons, as far as stock valuations.
Yeah, we'll see.
All right, so I think we are about running out of time, but yeah, it's a very interesting situation. Please let us know in the comments section below what you're thinking about the current situation, because these are very dynamic times we're living in, and if there is any further significant developments with Silicon Valley Bank or other banks or just in the stock market in general, we will do another podcast. Hopefully, not an emergency podcast.
Yeah, and yeah, just everyone make sure to stay safe out there. None of this is investing advice. Do your own work and be prepared to lose everything. And take care.